Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing PyroGenesis stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. PyroGenesis designs, develops, and manufactures plasma systems and plasma torch products. The company's proprietary plasma products use plasma to gasify and vitrify waste without producing hazardous byproducts. I did not know what vitrify meant, even though I've heard the word before. It is the act of converting something into glass or glass-like substance by exposing it to heat. This company's technology can be found in aircraft, iron ore, 3D printers, and waste treatment centers. For example, when a company produces iron ore pellets, there is a large amount of pollutants as a result of this process. PyroGenesis technology greatly reduces greenhouse gases. This month, a customer said they plan to purchase 36 plasma torches. One torch can cost anywhere from $2 to $3 million US. You may remember in science class being taught the 3 states of matter, which are solid, liquid, and gas. There are actually 4 states, not 3. The 4th is plasma. The company is headquartered in Montreal, Quebec, Canada, and was founded in 1991. The ticker trades on the Nasdaq, TSX, and Frankfurt Stock Exchange. Let's get started with the model. This is a small cap company, 453 million market cap. They're trading at $265 a share, and they have 171 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they're not bringing in much revenue at this point, so they do have negative free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative in 18 and 19, positive in 2020 and the trailing 12 months. Revenue is their sales, and that's 6x from 2019 to the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew from 1.1 million to 14 million. Below that is their operating expenses, and then below that is their operating income, which is negative every year. All their financials are in Canadian dollars. I converted these numbers to US dollars on my Excel spreadsheet since we're looking at the ticker that trades in the US. They spent $222,000 of interest on their debt, which is lower than prior years. The reason they have positive net income in 2020 and the trailing 12 months was this gain in other income and expenses. I'll explain this in a little more detail when we look at their income statement from their quarterly report. This is the company's income statement from the latest quarterly report. The first 9 months of 2020 versus the first 9 months of 2021. The third quarter of 2020 versus the third quarter of 2021. Their third quarter revenue is 9.3 million, up from 8.1 million. Here's a breakdown of their revenue by country. That's another plus about investing in this company is they can sell all over the world fairly easily. The country with the most revenue is India, then Saudi Arabia, then the US, then Canada. Their revenue is pretty diversified, which is great. Their revenue in Canada has decreased a lot. Same thing in Saudi Arabia. But India went from no revenue to 2.8 million, and the US revenue went up a lot as well. They spent $5.3 million to generate the 9.3 million of revenue. That mainly includes all the costs to manufacture their products. So their gross profit is 4 million, which is a lot lower than last year of 5.5 million. And last year they had less revenue. But their gross margins are still higher than the average in the industry. Their gross profit margin is 43%. That's gross profit over revenue. The industry average is 32%, the median is 33%. They spent 5 million in SG&A and 400,000 in R&D. So that gives them an operating loss in the third quarter of 2021. They did have an operating profit in the third quarter of 2020. The reason their net income is so high is due to this large gain. They own common stock in 2 companies that trade on the TSX Venture, ticker BGF and ticker HPQ. These are really small companies, but every quarter they have to mark to market their investments. The value of these investments is $27.6 million, And we'll see this dollar amount later on their asset section of their balance sheet, the non-current asset section. Let me give you an example of how this works. Say this company owned Facebook stock, and as of 12/31/21, the value of their stock was $100 million. In the first quarter of 2022, Facebook shares went down 30%, so the value of their stock is $70 million. So they have to report an unrealized loss of $30 million. They didn't actually lose anything because they still own the stock, but they just have to report it on their income statement. Let's pretend in the second quarter of 2022, Facebook stock goes back up, and now your stock is worth $100 million. At the end of the first quarter, your stock was worth $70 million. At the end of the second quarter, it was worth $100 million. Now you have to report a gain in other income and expenses of $30 million. It's possible your company has no connection with Facebook. You just bought the stock as an investment because you had a lot of cash on hand. So these types of items and other income and expenses should probably be ignored. It is good for you to know how their investments are doing. You could look at their balance sheet and figure that out. But it seems silly to pass it through as a gain or loss on the income statement because it really skews their net income number. But these are the accounting rules we have to live with. If you have a small business, you probably use cash accounting. If you use cash accounting, you never have to worry about these things. Cash accounting is easy because you only record things when cash occurs. When you own stock and it goes up or down, you didn't gain or lose anything, only when you sell the stock. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Even though they reported an accounting profit in 2020 and the trailing 12 months, we know those were mainly non-cash items. And this proves it right here. They lost $19 million of cash flow in the trailing 12 months, which is their worst year. And in 2020, they lost $800,000. Just because they lost $19 million of cash flow in the trailing 12 months doesn't mean it's a terrible thing. You need to look into this a little deeper. Maybe they invested a lot of money into R&D, and that's going to lead to greater growth in the future. That's just one example. And they don't spend too much in CapEx, about $1 to $2 million a year. Operating cash flow minus CapEx give you your free cash flow. And of course, they have negative free cash flow each year. They mainly run their business on capital stock. They issued $6.7 million in 2018, $3.7 million, and $12.3 million. When a company issues common stock, it increases the shares outstanding and makes your shares less valuable. When a company has negative operating cash flow, they shouldn't be using much debt. And it looks like they're trying to pay down their debt. They paid down a lot of debt in 2020. This is their operating and investing cash flows from their latest quarterly report, the third quarter of 2020 versus the third quarter of 2021. So in the third quarter of 2021, they reported a net gain of $623,000. And to calculate their cash flows, we need to add back the non-cash items on the income statement. Stock-based compensation is their biggest non-cash item, $670,000. And they spend a good amount in depreciation and amortization. But they passed through that large gain of $1.9 million when they had to revalue their common stock. But that's a non-cash item, so we minus that out here. And they had a cash outflow of $2.3 million in changes in working capital. An example of this are changes in accounts payable, accounts receivables, inventory. So even though they reported a net profit of $600,000, they actually lost $2.4 million of cash flow. Last year, they reported a net profit of $15 million, but they generated $2.4 million of cash flow. That is good they generated positive operating cash flow in 2020, but it's not good that it was negative in 2021. In their investing cash flow, they spent $220,000 in PP&E. Last year was $437,000. They spent $101,000 in business acquisitions. Last year was $48,000. It looks like they spent $1.2 million in acquiring common stock of those two companies we talked about earlier. Last year was $2.9 million, but they sold $2.1 million of common stock last year. It looks like they sold part of their business because they had a cash inflow of $1.1 million from business acquisitions. So in their investing section, they had a cash outflow of $400,000. Last year was a cash outflow of $1.4 million. This is the financing section on their statement of cash flows. They generated $680,000 in cash from the exercise of stock options. Last year, they had a lot of cash outflows. A loan for research and development, a term loan, $115,000. And a repayment of a lease liability, $1.2 million. This could be the lease on a factory or possibly on some of their equipment. and they received $1.2 million from the exercise of warrants. Warrants are just long-dated options that are sold by the company. So in their financing section, they had a cash inflow of $560,000. Last year was a cash outflow of $420,000. This is the equity section on their 9/30 balance sheet. They have $61 million of equity. They raised $97 million from selling their business, and they lost $36 million from running their business. Let's look at the capital structure. $48 million of equity, $5 million of debt. They're 91% equity, 9% debt. And they could pay off all the debt with the cash on their balance sheet and still have $8 million of cash left over. I gave them the lowest whack on Finbox, and that's a discount rate we're going to apply to the future cash flows. We estimated a little over 6 years of future free cash flows. We also estimated a terminal value, which is all cash flows past 2027. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $400 million. We divide that by 171 million shares. And we get a calculated stock price of $234. They're trading at $265, so they're trading at a 13% premium. It's a sell according to the model. It's really hard to value this company because they still have negative free cash flow, and their revenue is still small and it hasn't stabilized. To forecast their future revenue, I tried to look at the growth of their previous revenue numbers, also the future potential of their industry, and I just gave them a 50% annual growth rate up through 2027. And then a terminal value is a 2.5% growth rate into perpetuity. The average company in their industry converts 13% of their revenue into free cash flow. I multiplied their 25, 26, and 27 revenue by 13%. That's how I got their future free cash flows. And I just assumed they would have negative free cash flow up through 2024. So it's really anyone's guess on the future of this company. It depends on so many things, how well their products work, the demand, the competition. This is where the stock has been trading the last 2 years, so you can see it moves around a lot. It was over $10 one day. Look how big this wick is. So the stock opened slightly below $5 and it hit about $12 intraday. It ended up closing at $7.50. That's a lot of movement for one day. When the company gets a new contract, or if they're mentioned in the news for some reason, then the stock price usually goes up. So at this point, the stock price isn't based off of the company's fundamentals because it will be worth nothing because they're not bringing in any cash flow. It's based off of an investor's expectation of the future of the company. And there was a ton of trading activity on this day. Wow. The green or red lines down here are the volume of trading that day. The stock price increase on this day, it might be the result of this article about winning a contract with a customer. And this customer has 10 locations and they may need 50 plasma torches per location. That's about $1 billion of revenue just from this one customer. Their beta is 2.19, so the stock is volatile. It moves more than 2 times the market. It's gone down 48% in the past 52 weeks while the S&P is up 15%. The 52-week low is $1.72, the high is $12. And the stock is trading below its 50-day and 200-day moving average. Over 1 million shares are traded each day. Of the 171 million shares outstanding, 77 million are on float. A little over 1% are held by institutions, and 1% of the shares are shorted. There seems to be a lot of insider selling, not much insider buying. These are the insiders that have bought or sold the past year, the shares and the price. Half the shares are held by insiders, 44% by the general public, 4% by private companies, and 1% by institutions. The CEO of the company owns 42% of the stock. He's the biggest shareholder. He has 72 million shares, valued at 189 Canadian dollars. The CEO's name is Fotis Pascali, but his nickname is Peter. I'm not sure why they broke out his shares, but this is him again at 7%. A Canadian company owns 4.25%, then State Street, and then another executive at the company owns 0.38%. Let's look at their financial ratios. They have a really high PE ratio of 83. That's stock price over earnings per share. Their price to sales is also really high at 19. That's stock price over sales per share. If a company has a high price to sales ratio, that indicates there should be a lot of growth in the future. When a company has a low price to sales ratio, that usually indicates growth has stabilized. And their price to book is also on the higher side at 9.4. That's stock price over book value per share. Let's look at their non-current assets. $300,000 of deposits. These are cash deposits from customers so the company can start working on certain projects. $27.6 million of strategic investments. This is from the shares of common stock they hold on those two companies that trade on the TSX Venture. $3.6 million of property and equipment, $5.9 million of right-of-use assets. When you see right-of-use, that just means another company owns the asset, and this company is borrowing the asset. They're either leasing it or financing it. They have $900,000 of royalties receivables. Since their equipment may be expensive for some companies, they may give them the equipment for free or sell it at a discount but charge royalty payments. They have $2.3 million of goodwill. Goodwill is the premium you pay when you acquire another company, and $3.9 million of other intangible assets. These are also assets that were part of an acquisition, maybe intellectual property or patents. Their current ratio is 2.2, so they can cover their current liabilities more than 2 times with their current assets. Let's look at their current assets: $16 million of cash, $18 million of accounts receivables. This is how much money other companies owe this company. They have $3.3 million in cost and profits in excess of billings on uncompleted contracts and projects. So they're currently working on a project and the customer owes them $3.3 million, but they have to hit a certain milestone to actually bill the customer and receive the cash. It may be on a particular date, or it may be when they hit a certain milestone on the project. They have $500,000 of inventory, $300 million of tax credits. This will help reduce their tax bill in the future. They have $1.7 million of current portion of deposits. These are the current portion of deposits: $1.1 million of suppliers, $40,000 on rent, and $600,000 of security deposits. When the project is complete, then they can move these dollar amounts off the balance sheet and onto the income statement. $240,000 of royalty receivables, $440,000 of contract assets. This is a contract where multiple things need to be completed, and once done, they can move this dollar amount off the balance sheet and book it as revenue onto the income statement. And $1.5 million of other. Let's look at their current liabilities: $8.2 million of accounts payable. This is how much money this company owes other companies. $6.5 million of billings in excess of cost and profits. They owe $620,000 on a term loan. They owe $435,000 on a business combination. This is related to the acquisition of Air Science Technologies. And once certain items in the contract are completed, then they have to pay the company that $400,000. This $435,000 is in addition to what they already paid for the company. And $3 million on lease liabilities. They had negative $16 million of free cash flow in the trailing 12 months, and they have positive $18 million of working capital. So in order to get through the next 12 months, they may need to issue some debt or sell more common stock and dilute to shareholders. The best way to look at ratios is to compare them to companies in the same industry. There are 78 companies in the same industry as PYR, and they don't really have good ratios because they're pretty small of a company. They rank 65th in market cap, $453 million, average is $14 billion. So all their ratios are worse than average except debt to equity ratio. And the reason they don't take on a lot of debt is because they would have to pay a high interest rate, because they're a much bigger credit risk than, say, these top 10 companies. So to summarize, I have them trading at a 13% premium. I'm sure everybody would be supportive of what this company is doing, reducing pollutants and greenhouse gas emissions. The companies they support, like for instance the companies in the mining industry, they're notorious for having a negative impact on the planet because disposing of waste is a big deal. It's expensive, there's a lot of regulations involved, because a company can get into a lot of trouble if they don't do things properly. In addition to being good for the environment, they also help companies become more efficient. For instance, if a company uses their products, they'll get more output, more of a product than they would have doing it their old way. So if things go as planned, the stock could easily 10, 20, 50x. I rank their free cash flow as 1 out of 10, their revenue 4 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.